The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and or legal advisors before implementing any transactions and or strategies concerning your finances. And with that, let's get to this week's episode.
Hi everyone, Dr. B here with John G. Ullman and Associates. This is our market update for the week of September 23rd. If you're new to the channel, welcome, and thank you for joining us. The purpose of our channel is to leverage my background in economics to help you better understand the economy and the markets. Our goal is that offering these insights can help you better navigate the financial landscape and achieve your financial goals. So with that said, let's hit the books and get up to speed on the markets. So the big news last week was the Federal Reserve deciding to cut interest rates by 50 basis points, or 0.5%. The big question had been whether the Fed would go with a large cut or a small cut, and they chose the larger cut. In the press conference following the decision, Federal Reserve Chairperson Jerome Powell was explicit and clear that this was a strategic, proactive move in order to balance the Fed's priorities between the labor market and the fight against inflation, whereas after previous decisions, the primary focus had been bringing inflation down. The markets seemed pretty pleased with this result, as the Dow Jones Industrial Average was up by 1.6% on the week, the NASDAQ was up 1.5% on the week, and the S&P 500 was up 1.4% on the week. One of the sectors that we're watching is the financial sector. Traditionally, when interest rates are cut, the financial sector tends to see improved profit margins. Part of the reason for this is because their borrowing costs start to fall, but they don't necessarily drop the costs they charge or the interest rates they charge as quickly. So for a certain period of time, the profit margins for these financial institutions are able to expand and grow. Last week, we also got an update from the Conference Board and their leading economic indicator index. Unfortunately, the index fell last month to the lowest level since 2016. You may be wondering, what is the leading economic index? Well, it's a collection of statistics that we call economic indicators that tend to change before the larger economy changes. You can think of them as your warning light or your check engine light on your car. When these statistics show problems, we tend to see problems in the economy further down the road. Right now, some of those indicators are showing positive signs and some are showing negative signs. Unfortunately, three of the strongest negative signs are a lack of new orders in the manufacturing sector, some continued concerns among consumers about the future of the economy, and the interest rates. And although this drop in the index was smaller than the drop last month, it has definitely put us at a level where this should be concerning. Not surprisingly, with the update on the leading economic index, we're seeing some flights to safety. Over the last few weeks, we've seen the price of gold skyrocket. This tends to happen when investors are concerned about either a possible recession or inflation in the future. We're also seeing inflows or money flowing into investment-grade corporate bonds. Both of these tend to indicate some concern among investors. Despite the stock market's success, it's important that we pay attention to both the good news and the bad news and try to tell the difference. On a lighter note, we've seen record highs in the S&P 500 3 out of the last 5 trading days. So although there are some concerns about recession in the future, the economists and the traders seem to still have quite a bit of optimism. One of the big developments this week was the Chinese central bank starting to incorporate stimulative measures, meaning lowering interest rates and making financing easier in the Chinese economy, based on their concern with the possible slowdown or recession. You may wonder, why do we care about the Chinese central bank or the Chinese economy in general? Well, the easy answer is trade. The United States in 2022 exported $151 billion worth of goods and services to the Chinese economy. The biggest components of those exports were soybeans, integrated circuits, cars, and crude petroleum. So one of the reasons that we continue and investors continue to watch the Chinese economy is because the success or failure of the Chinese economy has a significant impact on our agriculture and manufacturing sectors. So if the Chinese economy is able to turn around and can start to grow again, we, at least in those specific sectors, could see significant benefits. We also saw some data this week from the Standard & Poor's Global Purchasing Managers Index. This index is a survey sent out to purchasing managers throughout the economy, asking questions about the condition of their economic situation and their expectations for the future. The important point coming out of this most recent data is that the service sector and the overall economy continue to show growth. The concerning information coming out of this data is that the manufacturing sector continues to struggle. With the leading economic index, we heard that manufacturing new orders are down. But in addition to those new order struggles, there have also been employment and working hour struggles in the manufacturing sector. And in order for the economy to grow and to find success in 2025, we need to see the manufacturing sector start to pull out of this contraction. The last piece of new information we've seen this week, so far, we saw consumer confidence reported by the Conference Board. Now, unfortunately, as I mentioned with the leading economic index, consumer confidence is struggling. The Consumer Confidence Report from the Conference Board demonstrated a significant decline, in fact, the largest decline since August of 2021. A big part of this decline is related to the labor market and concerns that finding a job or keeping a job may be harder in the future. Now, with that said, you may remember from last week we talked about the Consumer Sentiment Survey from the University of Michigan, and you may be wondering, what's the difference? Well, both of these are surveys. The Conference Board and the University of Michigan both conduct surveys of consumers trying to get an idea of how the consumers feel today and what they think the future is going to look like. The big difference between them is that the Conference Board survey is focused more on the labor market and the future of the employment situation, while the University of Michigan tends to focus more on consumer finances, household finances, and inflation. So one of the interesting pieces, and some of the new information we'll see later this week, is the University of Michigan's consumer sentiment, along with the Conference Board's consumer confidence. So by the end of this week, and most likely in next week's market update, we'll be able to contrast how consumers feel about the labor market with how consumers are feeling about inflation. It'll give us an excellent picture on where the consumer is and how they feel about spending money in the future. This brings us to the future. What else is coming out this week that we haven't seen? So the first big report coming out at the end of the week is the Personal Consumption Expenditures Inflation Measure. So you may remember last week we talked about the Consumer Price Index, which is one way of measuring inflation. The PCE, or Personal Consumption Expenditures, is another. And in fact, the PCE is the preferred measure of inflation used by the Federal Reserve. The PCE tends to be a little more complicated and a little more advanced than the CPI, but it also tends to better represent inflation across the economy, across all sectors. So all eyes will be on the PCE report to see if we continue to watch inflation fall, or in the near future, what the impact of the Federal Reserve's interest rate cuts may be. Later this week, we'll also see the final revision or the final report on second quarter gross domestic product. If you're not familiar with the process, the Bureau of Economic Analysis publishes each report 3 times. There's a preliminary report following the end of the quarter. There's a first revision 1 month later, and there's a second and final revision 1 month after that. Each revision includes more data and more understanding and allows us to get a more accurate picture of what that gross domestic product or GDP actually is. So the report this week will help us get the final picture on the second quarter and help us prepare for what we may expect in the third quarter. We'll also see data on durable goods, on the production and demand for durable goods. Last but not least, next Monday is the end of the third quarter of 2024. This is significant because as the quarter ends, all of the data, both at the corporate level and the economy level, starts to be collected and reported. This means that instead of looking back at the second quarter from April to June, we'll now be shifting our economic focus, both in the stock market and in the larger economy, to the period from July through September. As this new quarter unfolds, we'll get new earnings reports, we'll get new economic reports, and we'll get a better picture of how the last 3 months have occurred in the economy and what the next 3 months and next year could have in store for us. As always, we'll be watching these reports and the markets to help you stay up to speed on the economy. Thanks for joining us this week. Don't forget to come back next week. Also, don't forget to like and subscribe below if you found this information helpful.